I've made exactly 3 catastrophically stupid decisions in my life. Each one cost me tens of millions of dollars, and every single one happened because I violated the same 3-step formula I'm about to show you. I'm Charlie Munger. I'm 99 years old, and today I'm going to teach you the decision-making system that built a $700 billion company, and more importantly, the system that kept me from losing everything. Most people think they're good decision makers. They think they're rational. They think they evaluate the facts, weigh the options, and choose the best path forward. That's what everybody believes about themselves, but it's mostly delusion. The reality is, human beings are rationalizing machines, not rational machines. We make decisions based on emotion, bias, and mental shortcuts, and then we construct logical explanations after the fact. But here's what I learned over a lifetime of studying psychology, running businesses, and making investments with Warren Buffett. There is a systematic way to make better decisions. Not perfect decisions, that's impossible, but significantly better decisions than the average person. And if you can improve your decision-making, even modestly, the compound effects over a lifetime are extraordinary. By the way, I'm Charlie Munger. I'm 99 years old. I've made thousands of consequential decisions, some brilliant, many mediocre, a few spectacularly stupid, but on balance, my decisions have worked out reasonably well. Warren and I built Berkshire Hathaway using these same principles, and now I'm going to lay out the exact system I use. So in this video, I'm going to explain my 3-step formula for making better decisions. This is the actual process I follow every single time I face an important choice. Step 1, gathering the right mental models. Step 2, using the 2-track analysis that separates rational factors from psychological biases. Step 3, avoiding stupidity through systematic inversion. Master these 3 steps, and you'll make better decisions than 95% of people. The first step in making better decisions is having the right tools for thinking. And by tools, I mean mental models, frameworks for understanding how the world works. This is foundational. If you don't have good mental models, you're like a carpenter trying to build a house with only a hammer. You might get something built, but it won't be very good. Now, what do I mean by mental models? I mean the big ideas from the big disciplines, the fundamental principles that explain how systems behave. These models come from mathematics, physics, chemistry, biology, psychology, economics, engineering, and many others. And you need models from multiple disciplines because the world doesn't organize itself according to academic departments. This step, let me be very direct about this. Most people are trained in one discipline, and they try to solve every problem using that one discipline's tools. Economists think everything is about supply and demand. Engineers think everything is about optimization. Lawyers think everything is about precedent and argument. That's what I call the man with a hammer problem. To the man with a hammer, the world looks like a nail. That's what a dumb way to handle problems. The real world is complex, interconnected, multidisciplinary. A single business problem might involve psychology, economics, physics, and biology all at once. If you only have one mental model, you're going to miss most of what matters. How do you build a proper latticework of mental models? You study broadly. You read across disciplines. You extract the fundamental principles from each field and integrate them into a unified framework. This takes years, decades really, but it's not as hard as it sounds because you don't need to master every field. You just need to understand the core models. I estimate that 80 to 90 important models will carry about 90% of the freight in making you a worldly wise person. And of those, only a handful really carry very heavy weight. So we're not talking about memorizing thousands of concepts. We're talking about deeply understanding maybe 100 fundamental principles. Let me give you the specific models I use most frequently, the ones that do the heavy lifting in my decision-making process. From mathematics. The most important model is compound interest. This isn't just about money. It's about understanding exponential growth versus linear growth in any domain. When you grasp how small advantages compound over time, it changes everything about how you make decisions. Another critical mathematical model is permutations and combinations, understanding how possibilities explode as variables increase. This is what Fermat and Pascal worked out in their correspondence about gambling problems. It's elementary, but most people never learn to apply it routinely in life. From physics, I use the concept of critical mass and breakpoints. Systems remain stable until they hit a threshold. Then they rapidly shift to a new state. This happens constantly, in business, in markets, in social systems. Understanding when a system is approaching a breakpoint is enormously valuable. I also use the engineering concept of redundancy in backup systems. The best designs have multiple ways to succeed and multiple safeguards against failure. From chemistry, I use autocatalysis, when a reaction product becomes a catalyst for more of the same reaction, creating a self-reinforcing cycle. In business, this shows up as network effects. Each additional user makes the product more valuable, which attracts more users, which makes it even more valuable. When you find autocatalysis in a business model, that's extraordinarily powerful. From biology, the most important model is Darwinian evolution. Every business exists in an ecosystem where it must compete for resources and adapt to changing conditions. Understanding what makes an organism or a business evolutionarily fit is fundamental. What competitive advantages does it have? How durable are those advantages? Can competitors replicate them? These are biological questions applied to commerce. But the most important discipline of all, the one that does the most work in decision-making, is psychology, and specifically, the psychology of human misjudgment. This is ungodly important, and yet it's barely taught. I had to learn it on my own, late in life, one piece at a time. And when I was done, I felt like a complete horse's ass because it's so elementary. But very eminent places miseducated people like you and me on this subject. The psychology of misjudgment consists of about 25 cognitive biases, systematic errors the human brain makes. Let me give you the most important ones. Incentive-caused bias. This is number one because it's the most powerful. People respond to incentives in ways they don't even consciously recognize. Show me the incentives, and I'll show you the outcome. If you want to understand why someone is doing something that seems irrational, look at their incentives. 9 times out of 10, that explains it. Confirmation bias. We seek information that confirms what we already believe and ignore information that contradicts it. It's hardwired into the brain, and it causes enormous mischief. The only defense is to actively, deliberately seek out disconfirming evidence. Social proof. We look at what other people are doing and assume it must be correct. This is particularly powerful when we're uncertain, or when the other people are similar to us. Most bubbles and manias are driven by social proof run amok. Authority bias. We trust and obey authority figures, even when they're wrong. The Milgram experiments demonstrated this conclusively. People will do terrible things if an authority figure tells them to. In business and investing, this shows up as blindly following expert opinions. Commitment and consistency bias. Once we've made a decision or taken a position, we have an overwhelming urge to remain consistent with that position, even if circumstances change. This prevents us from updating our views when new information arrives. Now, here's the critical insight about these psychological biases. They affect everyone, including me, including you. You cannot eliminate them. They're built into the architecture of the human brain, but you can be aware of them. You can design systems and checklists that help you counteract them, and you can learn to recognize when other people are being influenced by them, which creates opportunities. The key to using mental models effectively is integration. You don't just know them, you fluently apply them in combination. When you're analyzing a decision, you automatically run through your models asking, what does psychology say about this? What does mathematics say? What does biology say? What does physics say? And here's where it gets really powerful. Sometimes multiple models all point in the same direction. They reinforce each other. I call this the Lollapalooza effect. When several biases or factors operate together in the same direction, you get outcomes far larger than the sum of the parts. Let me give you a concrete example. Take Coca-Cola as a business. Why is it so successful? You can't explain it with one model. You need many. Psychology. The brand creates powerful emotional associations and habits. Biology. The distribution system has network effects. Each node makes the whole more valuable. Economics. The business has enormous operating leverage once the brand is established. Mathematics. The cash flows compound at high rates with minimal reinvestment. When psychology, biology, economics, and mathematics all align, when every model points to exceptional durability and profitability, you found something rare. That's a Lollapalooza effect. That's when you pay attention and act decisively. But simply having mental models isn't enough. You need to know how to apply them systematically. Which brings me to step 2. Now we get to the actual decision-making process. And this is where most people go wrong, even smart people with good mental models. They think decision-making is purely rational. They think you just gather data, analyze it logically, and choose the optimal course. That's not how it works. Here's what I've learned. Good decision-making requires two-track analysis. You evaluate the decision on 2 completely different levels, simultaneously. Track 1 is rational analysis. What are the real interests involved? What are the actual probabilities? What does logic tell us? Track 2 is psychological analysis. What subconscious biases are operating, both in ourselves and in others. Let me explain track 1 first, the rational track. This is the way you'd work out a bridge problem. You evaluate the real interests, the real probabilities, the real constraints. You use mathematics, logic, and evidence. You try to see reality as it actually is, not as you wish it to be. For example, if you're evaluating an investment, the rational analysis includes: what are the unit economics of this business? What are the competitive dynamics of the industry? What's the quality and integrity of management? What's the probability-weighted range of outcomes? What's my margin of safety if things go wrong? These are objective questions with objective answers, at least in principle. The key to good rational analysis is asking the right questions. And the most important question, the one that unlocks everything else, is why. You need to keep asking why, until you reach the fundamental causes. Surface explanations are usually misleading. You have to dig down to the bedrock. I learned this from Carl Braun, who built oil refineries. He had a rule at his company called the 5 W's: who, what, where, when, and why. If you wrote a directive telling someone to do something without explaining why, you could get fired. And if you did it twice, you would get fired. That sounds extreme, but it's brilliant psychology. Why does this work? Because when you explain why, people understand better, they value it more, and they're more likely to comply. Even if they don't fully grasp your reasoning, they're still more likely to follow through. And for yourself, forcing yourself to articulate why forces you to understand the causal mechanisms, not just surface patterns. But rational analysis alone is insufficient. This is where most people, particularly educated people, particularly those with high IQs, make their mistakes. They think rationality is enough. They think if you just analyze the facts correctly, you'll make good decisions. That's wrong. Why is it wrong? Because humans are not rational actors. We're rationalizing actors. Our brains use shortcuts and heuristics that usually work, but sometimes misfire badly. And we're susceptible to manipulation by others who understand these psychological shortcuts. This is where track 2 comes in, psychological analysis. You simultaneously evaluate what psychological factors are causing subconscious conclusions, what biases might be operating, what incentives are shaping behavior, what social proof or authority influences are present. Let me give you a concrete example of how this works. Suppose you're considering an investment in a company that's being heavily promoted by Wall Street analysts. Track 1, rational. Look at the fundamentals: earnings, cash flow, competitive position, valuation. Let's say those look decent. Track 2, psychological. Ask different questions. Why are the analysts promoting this so heavily? What are their incentives? They get paid to generate trading volume and maintain relationships with corporate management. Are they subject to authority bias, just repeating what senior analysts or management told them? Is there social proof operating? Are they recommending it because everyone else is recommending it? You'd also examine your own psychology. Am I attracted to this investment because it's popular and I'll feel smart if it works out? Am I suffering from confirmation bias, only looking for information that supports buying it? Am I being influenced by the authority of these Wall Street analysts, even though I know their incentives aren't aligned with mine? This two-track analysis, rational and psychological, running in parallel, is how you actually make good decisions. You need both tracks. One without the other is insufficient. I'll give you another example, this time from my own experience. Back in the 1970s, there was a company called Blue Chip Stamps that most investors thought was a dying business. Trading stamps were going out of fashion. The rational analysis said, declining revenue, mature industry, no growth prospects. But my two-track analysis revealed something different. On the rational track, yes, the core business was declining, but Blue Chip Stamps had enormous float, cash from stamps sold but not yet redeemed, that could be invested. And it owned See's Candies, which had a powerful brand and pricing power. The market wasn't properly valuing these assets because everyone was fixated on the declining stamp business. On the psychological track, I could see why this mispricing existed. Social proof. Everyone agreed trading stamps were dying, so everyone avoided the stock. Availability bias. The stamp business was visible and easy to understand, while the hidden assets required deeper analysis. Commitment bias. Analysts who had written off the company years ago weren't willing to reassess. By running both tracks simultaneously, I could see an opportunity that others missed. The rational analysis showed hidden value. The psychological analysis explained why the market was mispricing it. That combination gave me the confidence to invest heavily. Now, let me tell you about the specific process I use for two-track analysis. It's systematic, not intuitive. I literally go through a checklist. For the rational track, I ask, what are the key variables that determine the outcome? What's the base rate? What usually happens in situations like this? What are the second-order and third-order consequences? What are the opportunity costs? What am I giving up by choosing this? What could go wrong? What's my margin of safety? For the psychological track, I ask, what incentives are shaping the actors in this situation? What biases might I be subject to? What's the social proof? What authority influences are present? What commitment or consistency pressures exist? Am I seeing this clearly, or am I seeing what I want to see? This sounds laborious, and when you're starting out, it is. But after decades of practice, it becomes automatic. The two-track analysis happens almost instantly. You develop what psychologists call fluency, the ability to apply complex models without conscious effort. But there's one more critical element to two-track analysis that I need to emphasize. You have to be brutally honest with yourself. The psychological track requires you to confront your own biases, your own incentives, your own wishful thinking. Most people can't do this. Their egos won't let them. I've gotten pretty good at it over the years, though I'm still not perfect. I still make mistakes driven by bias. But I've developed a trick that helps. I actively try to make the case against my own position. I ask, if I'm wrong about this, why am I wrong? What evidence would disprove my thesis? What would a smart person on the other side say? This is inversion, which is actually step 3 of my formula, but it ties directly into two-track analysis because inversion forces you to confront bias. When you try to prove yourself wrong, you counteract confirmation bias. When you imagine failure, you counteract overconfidence. When you seek disconfirming evidence, you counteract motivated reasoning. The two-track analysis, rational factors plus psychological factors, evaluated systematically and honestly, is how you make decisions that are actually good rather than just feeling good. It's the difference between being right and feeling right. Most people prefer feeling right. I prefer being right. But even with perfect two-track analysis, you can still make catastrophically bad decisions if you don't avoid the big mistakes. Which brings us to step 3. Now I'm going to tell you the most important part of my decision-making formula, and it's completely counterintuitive. Most people focus on what they should do to succeed. I focus on what I should avoid to not fail. It's a completely different orientation, and it changes everything. This idea comes from the great German mathematician Carl Jacobi, who said, invert, always invert. Instead of solving problems forward, solve them backward. Instead of asking, how do I make a good decision, ask, how do I avoid making a catastrophically bad decision? Why does this work? Because in decision-making, avoiding bad outcomes is more important than seeking good ones. The mathematics of loss is asymmetric. If you lose 50%, you need to gain 100% just to get back to even. If you lose 90%, you need to gain 900% to recover. Large losses are extremely difficult to overcome. Therefore, the first principle of good decision-making is simple. Don't screw up. Don't make decisions that can ruin you. Don't bet everything on one outcome. Don't ignore downside risk. Don't let overconfidence blind you to danger. The person who avoids catastrophic errors and makes moderately good decisions will outperform the person who makes brilliant decisions mixed with occasional disasters. Let me make this concrete. When I'm facing a decision, I don't start by asking, what's the best possible outcome? I start by asking, what are all the ways this could go catastrophically wrong? I list out the nightmare scenarios, and if any one of them would be devastating, I don't proceed. It doesn't matter how good the upside looks. If the downside is unacceptable, the answer is no. This is particularly important in investing, but it applies to all decisions. When I evaluate an investment, I spend more time thinking about what could go wrong than what could go right. What would cause this business to fail? What would cause me to lose most of my capital? What am I missing? What don't I understand? If I can't articulate a clear bear case, I don't invest. Because if I can't imagine how it fails, I don't understand it well enough. And if I don't understand it, I can't evaluate the risk. Now, let me give you the specific things I systematically avoid in decision-making. These are my never do this rules. First, never make decisions in businesses or domains you don't understand. I don't care how much money other people are making. I don't care how smart the people promoting it are. If I can't explain in simple terms how it works, I don't touch it. This kept me out of complex financial derivatives. It kept me out of technology businesses that were too complicated. It kept me out of countless other things that eventually blew up. The boundary of what I understand, what I call my circle of competence, is smaller than most people's. But within that circle, I really understand things deeply, and that's enough. You don't need to understand everything. You just need to stay within the circle of what you actually understand. Second, never work with people you don't trust. Life is too short to do business with people who are dishonest, incompetent, or unpleasant. I don't care how good the opportunity looks on paper. If I don't trust and respect the people involved, I pass. This has saved me from countless disasters over the years. How do you evaluate trust? You look at the person's track record. You look at their incentives. You ask, have they behaved well when it was costly to do so? Do they tell the truth even when it's inconvenient? Do they admit mistakes? Are they trying to be fair or to maximize their advantage? You can usually tell quite quickly if someone is trustworthy if you ask the right questions and pay attention to the answers. Third, never pay prices that eliminate your margin of safety. Even great businesses become bad investments if you pay too much. And too much means a price where, if things go moderately wrong, you'll lose significant capital. I want to buy things for substantially less than what I think they're worth. That margin of safety protects me when my analysis turns out to be wrong, which happens regularly. Fourth, never use leverage in a way that could wipe you out. Leverage magnifies both gains and losses. It can turn a moderate mistake into a catastrophic one. I've seen brilliant people destroyed by leverage. They were right about the fundamentals, but wrong about the timing, and the leverage killed them before they could be proven right. It's not worth the risk. Fifth, never make important decisions when you're emotional. Anger, fear, euphoria, stress, all of them impair judgment. I have a rule. If I'm feeling strong emotion about a decision, I wait 24 hours before acting. Usually, when I look at it the next day with a clear head, the answer is different than it would have been in the heat of the moment. These never do this rules are more important than any always do this rules. Why? Because one catastrophic error can wipe out decades of good decisions. If you avoid the catastrophic errors and make reasonable decisions the rest of the time, you'll do very well over a lifetime. Now, let me show you how inversion works in practice with a historical example. In the late 1990s, during the internet bubble, technology stocks were going parabolic. Companies with no revenue were being valued at billions of dollars. Everyone was making money. The consensus was that we were in a new era where traditional valuation didn't matter. Most investors asked, how much money can I make in tech stocks? That's the forward question. But I inverted it. I asked, how can I avoid losing money in tech stocks? Once I inverted the question, the answer became clear. I looked at the valuations, 100 times revenue in many cases. I looked at the business models. Most were unproven and burning cash. I looked at the psychology. Pure momentum trading with no fundamental analysis. I looked at the leverage in the system. Margin debt was through the roof. Then I asked, what are all the ways this ends badly? Well, valuations could revert to historical norms. Cash-burning companies could run out of money. Momentum could reverse. Leverage could force selling. Any of these would cause massive losses. So I inverted one more time. What do I need to do to avoid these losses? Answer, don't own tech stocks. Just sit it out. Miss the party. Look stupid while everyone else gets rich. That's exactly what Warren and I did. We sat out the entire tech bubble. People mocked us. The press called us out-of-touch old men. Our shareholders complained. But we didn't lose a penny when it all collapsed in 2000 and 2001 and wiped out trillions of dollars. That's inversion in action. By focusing on avoiding catastrophic loss rather than seeking maximum gain, we preserved our capital, and more importantly, we stayed in the game. When the bubble burst and prices became reasonable, we had capital to deploy. The people who chased the gains were wiped out and had nothing left. Let me give you another example of inversion, this time from everyday life rather than investing. Suppose you're trying to have a happy, successful life. Most people ask, what should I do to be happy? That's the forward question. But if you invert it, you ask, what are all the ways I could make myself miserable? Well, that's much easier to answer. Take drugs, destroy your reputation, marry someone you despise, work in a job you hate for money you don't need, burn bridges with everyone you care about, let envy and resentment consume you, spend more than you earn, never read or learn anything new, Now, how do you make inversion systematic? How do you actually build it into your decision-making process? I use several techniques. First, the premortem. Before committing to a decision, I imagine it's 5 years in the future, and the decision has failed catastrophically. Then I work backward. What happened? What went wrong? What signs did I miss? This forces me to confront risks I might otherwise ignore, thanks to optimism bias. Second, the checklist. I have a written list of questions I must answer before making important decisions. Not suggestions, requirements. These questions are designed to catch the common mistakes I know I'm prone to making. The checklist is my defense against my own psychology. Third, seeking out people who disagree. I actively look for smart people who have the opposite view from mine and listen carefully to their reasoning, not to argue, to understand where I might be wrong. Most people can't do this because their ego gets in the way, but it's enormously valuable. Fourth, the 24-hour rule. For any significant decision, I force myself to wait at least 24 hours before committing. This gives time for my initial emotional reaction to settle and for my rational mind to reassert itself. Often, the decision I make after waiting is quite different from what I would have done impulsively. Fifth, keeping a decision journal. I write down important decisions I make. What I decided, why I decided it, what I expected to happen. Then later I review them and analyze what I got right and what I got wrong. This creates a feedback loop that improves judgment over time. These techniques sound simple, and they are, but simple doesn't mean easy. The hard part isn't understanding them. It's having the discipline to use them every single time, even when you're confident and want to move fast. The greatest error in decision-making is overconfidence. Most mistakes come from being too sure you're right. When you're certain, you don't consider alternatives. You don't seek disconfirming evidence. You don't prepare for things going wrong. And that's when you get blindsided. Inversion is the antidote to overconfidence. By systematically asking, how could this go wrong? You force yourself to confront uncertainty. You maintain what I call intellectual humility, acknowledging what you don't know. And here's something else that's important about inversion. It's not just about avoiding bad outcomes in individual decisions. It's about avoiding the catastrophic errors that can destroy everything you built. One terrible decision can wipe out a lifetime of good ones. Think about all the brilliant people who've destroyed themselves or their companies through a single catastrophic error. Nick Leeson destroyed Barings Bank with reckless derivatives trading. Long-term capital management, run by Nobel Prize winners, blew up because they used too much leverage. Enron, WorldCom, Lehman Brothers, all destroyed by decisions that seemed smart at the time, but carried catastrophic downside risk. These weren't stupid people. They were, in many cases, much smarter than me, but they didn't systematically think about downside risk. They didn't ask, what if I'm wrong? They didn't practice inversion, and it destroyed them. That's why step 3 of my formula, inversion, avoiding stupidity, is actually the most important step. Steps 1 and 2 make you smart. Step 3 keeps you safe. And in the long run, staying safe is more important than being smart. Now let me show you how these 3 steps integrate into a complete decision-making system. Because the real power doesn't come from using each step in isolation. It comes from using them together, systematically. Here's how it works in practice. Suppose you're facing an important decision, maybe an investment, maybe a career choice, maybe a major business deal. You start with step one. What mental models apply to this situation? So you run through your lattice work. From mathematics, what do the probabilities tell you? From psychology, what biases might be operating? From biology, what's the competitive ecosystem? From economics, what are the incentives? From physics, are we near any breakpoints? You're building a multidimensional understanding of the situation. Then you move to step two, two-track analysis. On the rational track, what are the fundamental factors? What does logic tell you? What does the evidence show? On the psychological track, what biases are at play in yourself and in others? What incentives are driving behavior? Are you seeing reality clearly or seeing what you want to see? Finally, step three, inversion. Ask, what are all the ways this could go catastrophically wrong? Are any of those scenarios unacceptable? What do you need to avoid? What don't you understand? Where's your margin of safety? The three steps reinforce each other. Your mental models inform your two-track analysis. Your two-track analysis reveals what you need to avoid. Your inversion process helps you choose which mental models matter most. Thank you all. Let me show you how this worked in one of the best decisions Warren and I ever made together. The decision to buy See's candies through blue chip stamps back in 1972. Step one, mental models. From psychology, See's had incredibly powerful brand loyalty in California. People associated it with happy occasions and gift giving. That created pricing power. From biology, the business had favorable ecosystem dynamics, limited competition in premium box chocolates, high barriers to entry, and strong seasonal demand. From mathematics, the cash flows compounded beautifully because the business required minimal reinvestment. From economics, the business had attractive unit economics with high gross margins. Step two, two-track analysis. On the rational track, the business generated about $4 million in pre-tax earnings on $8 million of tangible capital. That's 50% returns on capital. The brand was strong. The business was stable. The asking price, $25 million, seemed expensive, but not crazy given the quality. On the psychological track, most investors wouldn't see the value. The company was small, not growing rapidly. There was no social proof. Nobody was talking about it. The hidden value in the brand wasn't on the balance sheet. Our ability to recognize the qualitative factors, brand strength, customer loyalty, pricing power, gave us an edge. Step three, inversion. What could go wrong? The brand could weaken, but it had survived for decades, including the Great Depression. Competition could intensify, but the premium box chocolate market was pretty stable. Quality could deteriorate under new ownership, but we would control that. The business could stop growing, but it was throwing off cash that we could redeploy. None of the failure scenarios looked devastating. The three-step analysis all pointed in the same direction. Strong mental models, favorable two-track analysis, acceptable downside risk. That's when you act decisively. We bought See's candies for $25 million. Since then, it's generated over $2 billion in profit for Berkshire. That's the power of systematic decision-making. I want to be clear about something. This system doesn't guarantee success. You'll still make mistakes. I certainly have. But this system significantly improves your odds. It reduces the frequency and magnitude of errors. And over many decisions, that produces dramatically better outcomes. Think about it probabilistically. If the average person makes good decisions 50% of the time, and this system helps you make good decisions 65 or 70% of the time, that doesn't sound like much, maybe a 15 to 20 percentage point improvement. But compounded over hundreds or thousands of decisions across a lifetime, that improvement is extraordinary. It is like batting average in baseball. The difference between a .250 hitter and a .300 hitter is enormous in terms of career outcomes and value, but it's just one additional hit per 20 at-bats. That tiny improvement, sustained over time, separates the mediocre from the elite. The same principle applies to decision-making. You don't need to be perfect. You just need to be consistently better than average. This three-step system, mental models, two-track analysis, and inversion, is how you do that. Let me give you one more example, this time a mistake I made, to show you how the system can fail if you don't follow it rigorously. Back in the 1990s, I had a chance to invest in a company that had all the right characteristics: strong business model, good management, reasonable price. My rational analysis said it was a solid opportunity, but I rushed the decision. I didn't do proper two-track analysis. I didn't examine my own psychological state carefully. I was feeling pressure to deploy capital. I was influenced by social proof. Other smart investors were buying it. And critically, I didn't do thorough inversion. I didn't spend enough time asking what could go wrong. I underestimated technological risks because they were outside my circle of competence. The investment worked out okay. I didn't lose money, but it didn't work out nearly as well as it should have given the apparent opportunity. What did I learn? That you cannot skip steps. The system only works if you follow it completely and honestly. If you rush, if you let emotion override analysis, if you don't do the hard work of inversion, you'll make mistakes. The discipline to follow the system consistently is harder than learning the system itself. That's where most people fail. They understand the concepts intellectually, but when they're excited about an opportunity, or anxious to act, or feeling pressure from others, they abandon the system. They make decisions based on emotion and rationalize it after the fact. I've been practicing this system for 60 years, and I still have to fight that tendency. The difference is, I've built habits and safeguards that help me stay disciplined. I have written checklists. I have people like Warren who challenge my thinking. I have a decision-making process that forces me to slow down and think carefully. You need to build similar safeguards for yourself. Write down your mental models. Create your own checklists. Find people who will honestly critique your decisions. Keep a decision journal. Build friction into your process so you can't make impulsive decisions. These safeguards aren't optional. They're essential, because the system only works if you actually use it consistently, even when it's inconvenient. Now let me make this tactical. How do you actually implement this three-step decision-making system in your own life? What are the specific actions you need to take? Step 1, building your latticework of mental models. This is a long-term project, not something you can do in a weekend. But you can start immediately. Here's how. Make a list of the major disciplines: mathematics, physics, chemistry, biology, psychology, economics, engineering, history. For each discipline, identify the 5 to 10 most fundamental principles. You don't need to become an expert. You just need to understand the core concepts well enough to apply them. Start reading. Read the classic texts in each field. For psychology, read Cialdini's Influence and Kahneman's Thinking Fast and Slow. For biology, read Darwin and Dawkins. For economics, read Smith, Ricardo, and Hayek. For mathematics, make sure you truly understand probability and compound interest. Work through the concepts until you can explain them simply. This will take years, that's fine. You're building a foundation that will serve you for decades. Be patient and thorough. Every month, add a few new mental models to your repertoire. Practice applying them to real situations. Over time, they'll become automatic. Now, implementing two-track analysis. This is more procedural. You need to create a systematic process that you follow every time you face an important decision. Create a decision template. Write down the key questions for both tracks. Rational track questions. What are the key variables? What are the probabilities? What's the base rate? What are the second-order effects? What are the opportunity costs? Psychological track questions. What incentives are operating? What biases might affect me? What's the social proof? What authority influences exist? Where might I be fooling myself? Before making any consequential decision, work through this template in writing. Not in your head, in writing. The act of writing forces you to think clearly and completely. It also creates a record you can review later to learn from your successes and failures. For really important decisions, go even further. Make the best case you can for the decision in writing. Then make the best case you can against the decision, also in writing. Try to steelman the opposing view. Make it as strong as possible, not as weak as possible. This counteracts confirmation bias and helps you see blind spots. Step 3. Making inversion systematic. Again, this requires creating procedures and habits. Create your never do this list. Write down the things you will never do regardless of circumstances. Maybe it's never use leverage in risky situations, or never invest in businesses I don't understand, or never work with people I don't trust. Whatever your list is, write it down and commit to following it. Use the pre-mortem technique for every major decision. Before committing, imagine the decision has failed completely. Write down what happened. What went wrong? What signs did you miss? This exercise surfaces risks you wouldn't otherwise consider. Build in waiting periods. For any decision above a certain threshold of importance, force yourself to wait. Maybe 24 hours, maybe a week. This gives your rational mind time to catch up with your emotional impulse. Now, here's something critical. You need to track your decisions and their outcomes. Keep a decision journal. For every important decision, record, what did you decide? Why did you decide it? What did you expect to happen? What actually happened? And what did you learn? This is important periodly, maybe quarterly or annually. Look for patterns. What types of decisions do you consistently get right? What types do you consistently get wrong? What biases do you repeatedly fall victim to? This feedback loop is how you improve your judgment over time. Let me also tell you what not to do. Don't try to implement all of this at once. Don't expect immediate perfection. Don't beat yourself up when you make mistakes. You will make mistakes, frequently. The goal isn't perfection. The goal is consistent improvement over time. Start small. Pick one mental model and practice applying it for a month. Then add another. Create one checklist and use it rigorously. Then refine it based on experience. Track a few decisions and review them. Then expand to tracking more. The compounding happens through consistency over time, not through intensity in short bursts. Better to practice this system at a sustainable pace for decades than to go all in for a few months and burn out. And remember, the system is a tool, not a religion. You need to adapt it to your own circumstances, your own strengths and weaknesses, your own domain. The 3 steps are universal: mental models, two-track analysis, inversion. But the specific implementation should be personal. Some people need more structure, others less. Some are naturally good at avoiding biases but struggle with quantitative analysis. Others are great with numbers but terrible at reading people. You need to know yourself and build a system that compensates for your weaknesses. One more thing. As you get better at this, you'll notice something interesting. The system becomes faster. When you're starting out, working through the 3 steps might take hours or days. But after years of practice, much of it becomes automatic. You develop what psychologists call fluency, the ability to apply complex frameworks almost instantaneously. Warren and I can often evaluate an investment opportunity in minutes, sometimes even seconds. We're not smarter than other people. We've just practiced the system for so long that it's become second nature. The mental models, the two-track analysis, the inversion, they all happen automatically. That's the goal. Not to consciously work through a complicated process every time, but to build the habits and instincts that make good decision-making automatic. But you can only get there through years of conscious, deliberate practice. So start now. Build your mental models. Implement two-track analysis. Practice inversion. Track your decisions and learn from them. Do this consistently, year after year, and you'll develop decision-making ability that compounds, just like financial capital. Before I finish, let me tell you about the most common mistakes people make when trying to implement this decision-making system. I've seen these errors hundreds of times, and they're worth avoiding. Mistake number 1, collecting mental models without applying them. Some people treat mental models like stamps in a collection. They read about them, memorize them, can recite them on demand, but they never actually use them in real decisions. The models stay abstract, academic, disconnected from reality. This is useless. The value of mental models comes entirely from application. You need to practice using them in real situations until they become fluent. When you're analyzing an investment, you should automatically think, what does psychology tell me? What does math tell me? What does biology tell me? If you're not actually using the models in your decision-making, you don't really know them. How do you fix this? Deliberately practice. Every time you face a decision, force yourself to explicitly apply at least 3 mental models from different disciplines. Write down what each model tells you. Over time, this becomes automatic. Mistake number 2, overcomplicating the two-track analysis. Some people get so caught up in sophisticated analysis that they miss the obvious. They create elaborate models with dozens of variables, run simulations, generate pages of analysis, and meanwhile they overlook the simple, glaring problem anyone could see. Good decision-making is about clear thinking, not complicated thinking. The point of two-track analysis isn't to be comprehensive. It's to be clear about what matters most. What are the 2 or 3 factors that will really determine the outcome? What are the 2 or 3 biases most likely to mislead you? Focus on those. Warren has a great phrase for this. It's better to be approximately right than precisely wrong. Don't let sophistication obscure clarity. If you can't explain your reasoning simply, you probably don't understand it well enough. Mistake number 3, using inversion as an excuse for inaction. Some people take the inversion principle and turn it into paralysis. They spend so much time imagining everything that could go wrong that they never actually make decisions. They avoid all risk, which means they also avoid all opportunity. That's not what inversion is about. Inversion is about avoiding catastrophic errors, not avoiding all errors. It's about making sure the downside is acceptable, not making sure the downside doesn't exist. Every decision involves uncertainty and risk. The question is whether you're being compensated appropriately for that risk. Don't let perfect be the enemy of good. You're trying to avoid stupidity, not achieve perfection. There's a huge difference. Mistake number 4, ignoring the psychological track. This one's especially common among highly analytical people, engineers, scientists, mathematicians. They're so good at rational analysis that they think that's all that matters. They ignore incentives, biases, social dynamics, and psychological factors. Then they're shocked when people behave irrationally. But the close people aren't rational. Understanding human psychology isn't optional if you want to make good decisions. The psychological track is at least as important as the rational track, maybe more so. If you're not considering psychological factors, you're missing half the picture. Mistake number 5, not building systems and checklists. Some people understand the concepts but rely on willpower to implement them. They think they'll just remember to use mental models, to do two-track analysis, to practice inversion. But willpower is unreliable, especially under pressure or when you're tired or emotional. Well, that's my 3-step formula for making better decisions. Build your latticework of mental models. Use two-track analysis to evaluate both rational and psychological factors. Practice inversion to avoid catastrophic mistakes. Simple in concept, difficult in execution, extraordinarily powerful when done consistently. Let me summarize the key points one more time. Step 1, mental models. You need fundamental principles from multiple disciplines: mathematics, physics, chemistry, biology, psychology, economics. About 80 to 90 models will carry 90% of the weight. Focus on the handful that really matter and learn to apply them fluently in combination. Step 2, two-track analysis. Every decision has 2 components. The rational track evaluates real interests, real probabilities, real constraints. The psychological track evaluates biases, incentives, subconscious influences. You need both tracks running simultaneously. One without the other is insufficient. Step 3, inversion. Always ask, what are all the ways this could go catastrophically wrong? Are any of those scenarios unacceptable? What do I need to avoid? Where's my margin of safety? Avoiding stupidity is more important than seeking brilliance. These 3 steps work together. Your mental models inform your two-track analysis. Your two-track analysis reveals what you need to avoid. Your inversion helps you choose which mental models matter most. It's an integrated system, not 3 separate techniques. Now, I should tell you honestly, most people won't do this. They'll read this, nod along, maybe take some notes, then go back to making decisions the way they always have, based on emotion, bias, and mental shortcuts, rationalizing after the fact, repeating the same mistakes. And that's fine. Their mediocrity creates opportunities for those of us who apply systematic decision-making. The fact that most people won't do the work is what makes it valuable for those who will. But if you're willing to do the work, to build mental models, practice two-track analysis, invert problems systematically, and do it consistently over years, you'll make better decisions than 95% of people. Not perfect decisions, but significantly better ones. And over a lifetime, that difference compounds. The system I've described isn't complicated. It's just hard to execute consistently. It requires humility, discipline, and patience. But after 60 years, I can tell you, it's worth it. It's helped us make money and, more importantly, avoid catastrophe. You don't get rich by making brilliant decisions. You get rich by avoiding stupid ones and letting compound interest work. This 3-step formula is how you do that. So that's my advice. Study broadly. Think clearly. Avoid disaster. Do this consistently, and you'll do just fine.